welcome to this podcast from the Private Wealth team at Safri. My name is Leonora Stevens and I'm a partner in the Private Wealth team based in Bristol. I'm delighted to be joined virtually by Mike Rogers, a fellow Private Wealth partner at Safri who's based in our Manchester office. Hello, Mike.
Hi, Leo.
Today we're talking about why clients may be thinking about incorporating their residential property portfolio, the tax and practical matters to consider, and the areas that you should be wary of. This is a topic that we see being discussed a great deal, and we frequently have inquiries from clients on this topic. The scenario usually tends to be where an individual or couple have accumulated rental properties over a period of years. They're paying the higher rates of tax on the rental profits with less benefits available, such as the deductibility of finance cost, plus high rates of CGT upon sale. Although the rate of CGT on residential properties has just reduced to 24% from 28%, with effect from the 6th of April 24. Then people wonder whether incorporating their business would be beneficial from an income tax or CGT perspective compared to the rates of corporation tax. Plus, when looking at the succession for their business, they want to consider the IHT implications and potential planning options of owning a property portfolio personally versus a corporate structure. In this podcast, we'll cover off the key tax differences of holding a property in your own name versus a corporate, which may provide people with some clarity as to why property business owners are considering incorporation. Then we'll look at what taxes would be due on incorporating the business into a company. Plus, we'll cover off a few of the traps and areas to be wary of, plus discuss our current thoughts on this area now that the CGT rates have reduced to 24% on resi property, which is lower than the rate of corporation tax. I would add that each client scenario is different, so do get in touch if you'd like to discuss any of the points raised today. So Mike, first things first, would you like to summarise why people might be thinking about incorporating their residential property business?
Yeah, it is one of those things, as you've said quite rightly, every situation is different. So that's my initial caveat. I think it's partly, and something we've talked about previously, fix a flavour of the day. And this is, if you like, a part of that same theme. And you have felt like the government wants to discourage residential property owners. And I went back when we were looking at this as a topic to discuss to George Osborne's 2015 summer budget, which is where he started this restriction on interest relief. And he said at that point, and I've never seen the background to this, that the Bank of England saw at that point buy-to-let properties as one of the biggest risks to the economy. And I've wondered since whether that was because they thought property just seems to feel instinctively a thing that people like to do, bricks and mortar security and all of that, but whether they were worried about property values, negative equity and those sorts of things, don't know. But that felt like the start of this direction of travel. And then I think people just look at headline rates and say, well, if I've got property that I own, if I'm now restricted to a basic rate, 20% deduction for interest, and I'm going to be taxed at up to 45% as an individual, compare and contrast company rates. Okay, they've now gone up, but 25% seems like a more attractive rate. You've referenced capital gains. Capital gains, you don't get the advantage because, again, a company at 25%, individual will be at 18 and now 24, down from 28. And if you've got your property in a company, and we'll come back to how you do that in a minute, you can turn the tap on or off. It's not as if every pound of income of profit is taxed on you, because you would have your company and you would pay it out through dividends most typically. And you can have rates as low as 8 3/4 or up to effectively 40%, 39.35%, which are only a tax system like the UK has come up with a 39.35% rate, wouldn't it? And I guess also one thing that people look at in the FIC environment, and if there is a loan account, drawing money out tax-free to repay the loan rather than as income. So I guess those are the main reasons. If you, Leah, were looking at that, going to an incorporation and transferring your properties into a company, what would be the main tax implications?
Well, there are obviously various taxes to consider, and it's easier to sort of break each tax down on the transfer. Well, first of all, currently you go into the position, you own properties in your own name, and you are therefore transferring them into the company. So you're making a disposal for CGT purposes, which would be at a full market rate. So you'd be taxed on the gain at 24%. And I say that would be then held by a company. You then look at, you've got an SDLT, stamp duty land tax implication. So the company would be in effect acquiring the property. And, if the value of the property is more than £500,000, then there would be an SDLT rate at up to 15%. Once the property is within the company, you've got potential for something called the annual tax on enveloped properties. So you need to consider that. There are exemptions, but that also needs to be thought through. But the good thing is, if a client has a sizable portfolio and they're sitting on a large amount of gain, there is a relief from the CGT. And in certain circumstances, you can get a relief from the SDLT. Mike, do you want to explain CGT relief on incorporation?
Yes, there is a specific, if you're really into your tax rules, if you are incorporating a business, there is a specific exemption. So you can take your business and put it into a company free of capital gains tax. I suppose, as with all tax rules, words of warning, it must be a business. And there's an example from a couple of years ago, someone in one of our sort of trade rags taxation magazine, there's a reader's questions bit, and someone said, I put a client and looking at incorporating a property. And the answer, which I think comes from quite a well-known expert in tax as well, you're probably not there already. And this is something the client's already done. You're not there because one property is very unlikely to be a business. So again, beware. And just to emphasize that, with a business, you're looking at some level of activity, and HMRC will have this rule of thumb of 20 hours a week is the kind of activity you'd need. So again, if you've got one residential property, you're not going to satisfy that. And you have to transfer in all the assets or the assets less the cash in the business. And then I suppose the point is you've deferred your initial gain. So if you were ever to sell the shares of that company, the gain would come back in, but the properties have been revalued to market value in the company. So if the company then sells, that you've got that benefit. You referenced, Leo, the SDLT position, and SDLT is the potential elephant trap here, I guess, because at face value, you'd say you've got an SDLT charge. There is an exemption because of the very peculiar way that partnership rules work. If a partnership is transferring property into a company, my word of warning there is I have seen promoters of tax schemes which you and I and we as a firm would go nowhere near, suggesting to an individual owner, well, go into partnership and then incorporate. And I think that's very aggressive. If I'm an individual with a property, I bring my wife into partnership, we incorporate. Well, why have we done that? We've done that just for the tax relief. So I think you can expect the taxman to be all over that. So I would be very wary of that. But we have to flag that these people out there promoting some of this planning.
And with the partnership, also the revenue, you're interrogating that partnership. Is it actually a partnership?
Yes.
How can you demonstrate that it is actually a partnership, but it's not just husband and wife jointly holding something and saying it's a partnership?
Absolutely.
There has to be a substance to that.
Absolutely right. And I think I mentioned to you that I went out to see a prospect many, many, many years ago, and they were clearly looking at different advisors because I went into a room and on the whiteboard from a previous meeting they had with another tax advisor, there was this set out: 1, you own property; 2, partnership; 3, limited company. And I said to them, if HMRC saw that all planned from day one, you stand a very strong chance of that not working at all, because you've done it just for the tax advantage. And as you say, all the genuineness has been sucked out of.
But I suppose that also don't detract from the point that there are genuine circumstances where it can apply.
Oh yeah,
commercial reasons and things were genuinely, and that was the intention to run as a partnership. And in due course, many years down the track, they might say actually it is better to incorporate now.
There is
that option to consider. But
absolutely right, and that's why it comes back to case by case, doesn't it? It's where you push the tax rules too far and you're too greedy that sometimes you can come unstuck. So I just flag that. So
before I was just going to mention about CGT, and obviously the incorporation relief is great from a CGT perspective and SDLT, but some people may be of the opinion that we've got relatively low rates of CGT now. 24% on a residential property is probably relatively low in the grand scheme of things. And is it ever going to be that low again? Is it only going to go up? Do they actually crystallise that gain now? pay the tax when it's at a rate that's not minimal, but if people are happy with that rate, do they crystallize it, and then it goes into the company at market value anyway, and then the ongoing sort of benefit is that the smaller gain will be taxed at 25%. And if you've incorporated and got the incorporation relief, if you sold the business or wound up in years to come, what would be your tax rate then?
Yep.
So it's just sort of winding up, looking at the overall position and your longer term view.
Yes.
But then looking at the inheritance tax perspective, obviously, if you own something in your own name and say you've got 10 properties that you're renting out, sadly, that is unlikely to qualify as a sort of a trading business for IHT relief. So it would be all subject to inheritance tax at 40%. Again, equally, if you'd incorporated all 10 properties into a company and you held the shares, on your death, the value of the properties would be represented in the share. So you would have a similar position. The benefit, though, of the corporate structure is that you can give shares away during your lifetime or on death. So if you've got 4 children and you've got 10 properties, you can divide the shares equally by the number of children, whereas it's harder to divide a property in 10 properties in 4 ways. So that is an added benefit, but there is no magic solution. And I think there's a lot of thought to be given for people who hold it in their own name or through a corporate, whether they're looking at lifetime gifts, share classes. But I think as we always say, it really depends on the client's wishes and what they want. Because from a practical perspective, would you be recommending incorporation to clients?
As a general proposition, yes, because it does have the advantages, and exactly the point you made. I came across someone who'd got a large property portfolio, and he was saying, well, I don't know which ones are going to be good, bad, or indifferent. So I left the individual properties to my family. There'd be losers and winners, whereas in a company, the shares take a mixed view of the whole portfolio. So definitely in the right circumstances, it is one where you can't escape from modeling the whole thing, calculating all the taxes, and as I hope we've demonstrated, it is all the taxes, and you can't ignore some of them and just assume it will be right. But for the right circumstances, because as I say, it's part of a subset, if you like, of the whole FIC discussion that we've explored before. So I think it's part of that.
Well, exactly. If historically people would often think of holding a residential property as a sort of some form of pension, but if they were to incorporate, and ultimately a lot of the properties would be liquidated, that can then form their sort of investment company and have sort of an investment pot within that, and then benefit from all the sort of the various benefits of dividend income being tax-free within the company, and that sort of thing. So there are longer term benefits, but I think it just depends on the size, the number of properties, what the aim is. Do they actually want to hold these properties for the long term, or will the next generation think, well, actually we can't be bothered with the rental business anymore, sell the properties within the company and off they go.
Yeah. And I think there is a concept of scale, isn't there? I would quite often find myself saying, look, if you've got one property, ignoring the business incorporation for CGT, if you've got one property and you're likely to need the proceeds, or you need all of the income, so if it was in your company, you'd have to take out a dividend that same year, you haven't achieved anything from an income perspective. It's the roll up at a lower rate of tax in a corporate that gives you the advantage. So typically you have to have a bit of scale to make it worthwhile. But subject to that, it's definitely something to explore.
I would also say that if you're thinking of incorporating and there is a potential that any of your children or relatives might use any of those properties, then consideration needs to be given to that before you do that, because that has other tax implications that also need to be thought about. So say properties held in corporates, that adds complexities, but then again, it works for the right for certain people, and therefore that's why the joys of our jobs is that everyone's and we get to sort of chew the fat on all these different ideas. But would you have any key takeaways, Mike, from this discussion?
I think come to us for advice, Leo, because no, that sounds like a cheap sell, doesn't it? But no two circumstances are the same, and it really does depend on what you're trying to achieve. And I think, as you've said, longer term planning, then there's definitely mileage in it. And to mention it, it's part. I think it's part of your overall strategy, isn't it, for tax and investments? And I do quite like the idea of some property and some other investments as part of a family pot of wealth. And as we've said, companies are more and more the vehicle for those sorts of situations.
Yeah, well, hopefully that's provided our listeners with just a flavour of what incorporation entails. And if you'd like to read more, please do visit our website, where we have a fact sheet on incorporating your residential property portfolio. There are, as highlighted today, there are a lot of different tax elements that you need to be wary of. So that's why it's always good to get advice early. So thank you, Mike, for joining me today. We work with a wide range of clients. Many are UK-based and many live overseas but have interests here, whether that's property, business interests, or investments. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. If you'd like to find out more about the services we can offer at Safri, please visit our website at www.safri.com. However, it's important for me to stress that if you're considering any of the topics discussed today, you must always take professional advice based on your individual circumstances. Thank you for listening.